for ex-US is higher than US. Go look at from beginning of 2014 to now, US versus everything else, right? So I would just like to highlight that predicting forward returns is a very hard thing.
Yeah.
And caveat everything with that. Does that make sense?
Yes, but all the asset managers, GMO, BlackRock, and many more, all of them in their volatility of distribution assumptions show that in all cases, especially in worst case scenarios, the real return for emerging markets equities would be positive. So wouldn't you consider that as being a margin of safety, or you consider that all these models might be wrong and the, let's say, valuation mean reversion patterns can change very badly in the next decade?
I'm not saying overweighting EM is bad. I don't think that's what I'm trying to say. All I would just want to highlight is that it's really hard to predict future returns in asset classes.
But
and a simple, like a pretty simple approach.
Yes.
It is like if you just did like momentum of like even within equities, like like US or ex-US, something like that, right? And just go look at how that would have done. Like you would have been in emerging and international during the 2000s. You would have been in US since like 2010.
From what I researched, momentum does perform poorly in emerging markets. But in the same time, the value premium is higher, and also the small premium is lower in emerging markets and higher in developed.
Yeah. Yep. They're all valid statements. I just want to highlight that, predicting the future returns is just hard.
Yes, I know that. My question is for the equity part, which would be the most efficient in a risk-adjusted terms, let's say, for a long-term investor who is interested in an optimized version for balancing risk and reward. So not chasing only short-term returns or momentum like US stocks are the hottest, but in the same time, maybe not going all in for emerging markets, So...
Yeah, I mean, I do think emerging and international are probably going to have higher returns in the next 10 years. Like I'll caveat it with that.
Yeah.
I actually do think that's the case.
So if you trained in bets, you have to assign a certain probability for that. Let's say, I don't know, 70%. And if 70% is the probability for EM to outperform, then perhaps you allocate 70% to that, right?
Yeah. Yep. Yeah,
So,
that kind of makes sense.
Let's say, how much is the probability, from your knowledge, for, let's say, global developed equities to outperform emerging markets?
That one's hard. That one I think is closer than US and emerging,
So US and emerging, it's more probable for emerging to outperform US, but global developed, where we also have Europe and other cheaper equities, it's much harder.
Well, yeah, because the spread's not as wide, right? Like the wider the valuation spread, the higher the chance that if nothing else happens, that's going to happen.
Okay.
But developed ex-US to EM, I would say, is different than EM compared to US.
Let's say EM compared to US maybe 80-20 and EM compared to global developed ex-US 60-40 or something like that.
Yeah, something around there. Yep.
And if you want to, let's say, split them in three, US, Europe, and EM, would you consider, I don't know, 20% US, 30% Europe, 50% emerging markets, something like that? Or how do you...
All I'm saying is, relative to just global market cap weight,
yes,
you're going to be way overweight EM. That's all I was just trying to highlight.
I know that. I'm just saying, we all know that even if you make the best decisions based on the available data, even the best decision in rational terms might not be the best performing allocation for the next decade, because we can't predict the future. but
Yep.
we can still make the best decision.
Yep. No. I think what you're doing is on the right track. Just as I've seen people, the more I do this, the one thing I would say is like you have to almost know your own personality and your own like the worst investors do the following. They would make like what you're proposing,
And
overweight EM,
and then sell at the bottom.
and then in 5 years when it's underperformed, you switch. You know what I mean? So
Yeah,
I would just say you have to understand your own like future. You almost kind of have to know your future regret
Yeah.
and what that is.
I think there are some Dalbar studies showing that people who consider themselves as being buy and hold investor are actually not buy and hold because they panic or they need liquidity somewhere in, let's say, a few years. So perhaps this is the most difficult thing, to stay the course and continue allocating the same way as when you begin investing.
Yeah. So I mean, again, I think you have a decent portfolio. I just wanted to highlight one deviation, which you clearly understand the
Yes.
bet you're taking. So I think that makes sense on the equities. And then you were asking about like the diversifier portion.
Yes, yes. It's an important issue because from what I have researched, rates are not a good diversifier because they maximize drawdown. They are very correlated with European equities and perhaps also correlated with other type of equities. On the same time, emerging markets, local currency bonds are very correlated. From research from Van Eck, they had 0.8 with emerging market equities. So assuming we overweight EM, then EM, local currency, or even hard debt is not a good diversifier for the bonds allocation. On the same time, bonds from developed markets have negative, both nominal and real expected returns. So they might be negatively correlated, but they don't bring us any benefit at portfolio level if they bring us negative returns. On the other hand, we have gold, which is non-correlated but not negatively correlated, which might be good for, let's say, a very tiny allocation. I always hear Ray Dalio talking about gold. On the other side, Ben Ferris considers that gold is not a good hedging for inflation in many other countries except for reserve currencies, and at the same time it does not offer a positive real expected return. So very hard argument to consider gold in your portfolio. Okay, 5% might work, but more than that, not.
Yeah.
And it's also pretty volatile.
Yeah, what I'd say is the simplest approach
Yes.
is always just keep some cash, right?
I always keep some cash. I'm actually have a lot of cash because before trying to read more about investment, I was trying to market time. I mean, I was thinking of a crash that might come and the markets would go down with 50%, and then I will start investing my cash. But I somehow realized that it's not that easy to do it.
Yeah. Market timing is hard, but what I'd say is if you can't decide upon like what the best diversifier is, the second best option, I think cash is not bad.
Cash.
Now, what I'll say is on diversifiers,
Yes.
you want them obviously, and you're on the right track of looking at correlations, right?
Mm-hmm.
And you also want to look specifically at correlations, like kind of when equities do poorly, right? Because if you're a highly equity-centric investor, to the extent you have any diversification, right, you want it to do well when equities do poorly. So, I would say the two main asset classes that I think are the simplest to understand are just, government bonds and then like commodities, right?
Yes,
and so
but
for the past 40 years, right, because if you looked in the U.S., interest rates have just gone straight down.
Yeah, we had a
every single
bull market on bonds.
Yeah. Yep. But what I'll say is if you get an equity drawdown whereby it's a deflationary flight to quality response, right? U.S. Treasuries are probably the best.
Yeah,
right?
But then again, if you take currency risk and you're not from US, it might not be that well because
Yeah.
US is also, I mean, USD is also somehow overvalued, and I
Yeah.
also think that if you believe in mean reversion, it might also happen at currency level. So
Yep.
I just don't like now with that with that
Yep.
much monetary stimulus and with the yields going down, especially in US as well. It's the advantage. I mean, the edge is lower for allocating to US
Yep. Well,
bonds.
all I'll just say is like the way I view diversifiers is you kind of have like two states of the world, in which case, like if equities do poorly, you got deflation, flight to quality, or you got hyperinflation. You kind of really get one of two options. That's it.
Yeah, and
right?
for deflation, perhaps you have cash. I mean,
Yeah, and that's why I say cash is not bad.
so
And
cash is
then-
not trash. Like,
Yeah, no, I don't think it is at all. A lot of good investors can do 85, 90% stocks, 10-15% cash, and then if things go down and then they
to be
re-up
honest,
their
I
equity.
have more than 80% in cash, but with this mindset to buy more on corrections, but everybody tells me that I market timing if I have a high cash allocation. I just don't see a better hedge in this environment for the
Yeah.
retail investor.
Yeah, I actually kind of agree. I think we're just lucky as U.S. investors in that, in general, like we can actually get those two allocations. We can get the deflation, flight to quality, and then the hyperinflation, right? Because we can just say, hey, we're going to do bonds, U.S. Treasuries. That's it. We're not going to do anything else. No corporates, no munis, right?
Yeah.
And then we can pair that with commodities, right? Because you can say, hey, we don't think commodities are great. Like, there's no benefit to just buy and hold them. But, if things blow up, this is why people talk about gold, right? Because
Yeah.
gold is just your hyperinflation hedge.
Yes, and it's also a low yielding hedge, let's say. I mean, in
Well, it has no
Eurozone, you
yield.
don't,
Yeah.
even at bank deposits, we no longer get any yield right now. So what to do with euros? You keep them in your current account? Okay, but then why not also add at least a tiny gold allocation, which also has no yield, but which here I'm not sure. I'm not sure which are the risks for high inflation in Eurozone. I feel that Eurozone is a very deflationary zone. Like, for instance, Japan was. What do you think here?
Yeah, I think all of developed economies are in deflation, almost, in a low inflation-ish type environment. So that's probably true. And then the one thing you highlighted and we chatted about earlier in the email chain was like trend following. One of the nice things about having trend following is, if there is like a dynamic change in something, which probably will happen in the next 100 years, right? Trend following is good to have because it's going to pick up on that, right?
So that could be the second best, or maybe the best diversifier together with gold, the managed futures ETFs for a retail investor.
Yeah, I don't know about ETFs just because, again, you're Europe, so you'd have to look. I know in the US, like ETFs with managed futures are really not that good. Just because the way the SEC structured the laws, like mutual funds are a better option. But yeah, managed futures with just simple trend following are a pretty good, I think, alternative to equities.
For hedging, we would have cash for the deflationary potential, and also for, let's say, buying more equities when they go down. And for inflation, we have gold and managed futures.
Yeah, and
about-
well, the nice thing about managed futures is they can go both ways. That's why I really like managed futures, right? Because in theory, if like right now we're in deflation, so managed futures pick that up because you're going to be long government bonds, short commodities. Wow, that's a great trade, right? If in 30 years it's, hey, there's a new world order and everything's getting hyperinflated away.
Yes.
well, then you're going to be short bonds, long commodities.
Yes,
That's great.
that's also
That's
a
why
question.
managed futures.
You know,
Yeah.
you might think, okay, emerging markets equities are cheap now, but if we're going to deflation, does it help? Because they are rather inflationary hedges, being commodity-driven countries. But also you can think about buying hedges when they are cheap, right? Not when everybody sees that there's hyperinflation.
Yeah, I agree. Actually, I do have to hop off here in 2 minutes just because I have a call at 11:30 I got to prep for. But yeah, I mean,
my last question, because this
Sure.
is a topic I have researched, but I haven't gotten any, let's say, conclusion. It's whether it does make any sense to add local currency bonds in for emerging markets sovereigns. Most of the currencies are crashed, but in the same time, Ray Dalio says that only main reserve currencies can protect better their currencies, and that these smaller countries are very risky at currency level. Do you think they might be added because they are cheap, or do you think that the risk of further devaluations are that high that we shouldn't do that? In the same time, they might be the single left positively yielding sovereigns around the globe, but not inversely correlated with equities.
yeah, I mean, I personally don't have any EM currency bonds, and it's just that's a lot I would say outside my purview expertise. What I will say is, I do agree that some of these have higher yields, but you just take on massive, currency deflation risk, which is probably going to be way more volatile than just yields.
So basically, if you take currency risk in emerging markets, at least do it for equities, right?
Yeah, that's what I would do.
Okay then.
So
in this portfolio, we will have equities, we will have managed futures and gold, and apart from that, we might also keep a cash pile for a deflationary hedge.
Yeah, sounds good.
And that's all. No bonds.
No, I'm not. Well, I don't know. I just bonds are interesting right now. This year, U.S. investors should have been on the long duration bond trade. That would have been the best performing asset, right? But
going
forward, I mean, basically, I kind of would prefer just equities with managed futures, right? I kind of think that's
so you think that a combination between equities and managed futures would be enough?
Yeah, that's what you have, right? Because remember, gold is going to be in managed futures.
I know that, but everybody. Yeah. Why doesn't Mr. Dalio also discuss about?
I don't know why he doesn't. To
and
be quite
also,
honest.
I've seen a report from I think J.P. Morgan, where gold was the most overvalued commodity. I mean, all other commodities were rather cheap, but gold was quite overvalued. In the same time, a lot of people say about increasing money supply, and this might be a reason that gold can still increase in value. But also, maybe gold only in a tiny allocation, let's say 4% of your entire cash pile, like more of an insurance.
Yeah, that's not bad. No,
yeah,
that's not bad.
And that portfolio level, keep only equities and managed futures.
Yeah.
80-20, let's say.
Yeah, I think that's a decent allocation.
That's great.
So, all right. Victor, it was nice chatting with you. Sorry, I do have to hop off, though. I got to get ready for
Thank you very much. Very nice discussion we had.
All right. Have a great day, night, and weekend.
You too. Bye-bye. Thank you very much.
Bye.
Bye-bye.